Hi, I'm Kerry. I'm a retired financial advisor. I'm not your financial advisor, but I am a retired financial advisor. And so I have some habits that I can't break. And one of those is once we pass the middle of the year, I start thinking about managing my taxes. I'm 76 years old, so I qualify for the required minimum distributions. That is, any qualified money, that is IRAs, 401ks, 403bs, Roth IRAs, yeah, I have to take a required minimum distribution. And so I start to thinking, how is that going to affect my taxes? And how can I manage it to minimize my taxes? And that's just how I think. So I want you thinking that way. I want you to take advantage of what I've learned and what I implement, and maybe it can help you. So my situation is that a major part of my portfolio is in what we call qualified assets, IRAs. And I have to take a percentage. It's a multiple. It's about I take the balance and I divide it by a number that I can get through my brokerage account, or I can just Google it and find out. And I have to take that out of both Nita and I's IRAs. That is reported then as ordinary income. So I'm anticipating that I'm going to take about $40,000 out of our two IRAs, and I'm going to have to pay taxes on it. I figure somewhere in the neighborhood of $15,000 worth of taxes. I don't like paying taxes, so I think about what can I do to offset that, because again, it's ordinary income, it's not capital gains. Well, the first thing I want to think about is, how am I going to take it? Am I just going to take a stock and transfer it from an IRA to my non-qualified account? No, I am not going to do that, because if I do that, I also move the cost basis with it. So the first thing I want to do is sell it. I want to sell it and then take the proceeds and move that into my non qualified account. Now, what I will do in my situation is take the stock and sell the stock that I believe has the greatest growth potential over the next 15 years. Why 15 years? Because I think I'll be dead after 15 years, and I want to pass that stock on to my heirs, the stock that has the greatest growth potential. Now, why is that important? Because in my non-qualified account, when I move the cash, such as what I'm planning on moving is a stock by the name of Intella. It is a genome sequencing or genome editing stock that I'm up about 200% on. And I believe I'll get another 200% at least out of it over the next 15 years. So I want to sell it in my qualified account, move it over into my non-qualified account, and immediately buy it back. Why is that? Again, I believe it's going to grow. Why is that important? Because if I then don't sell it and I pass it on to my heirs, they get a step up in cost basis. Well, what does that mean? Well, I'm not real sure what it sells for, but let's assume it sells for $250. I sell it over in my qualified account for $250. I bring that same over and I buy it immediately again for $250. Well, my cost basis is somewhere around $75. Okay. If I moved the stock over to the non-qualified account, I'd move the cost basis. But because I sold it and then I bought it back, it now has the new cost basis of, let's say, $200. When I die, it gets a step up in basis. So let's say it grows to now over there from 200 to 400, it doubles in price again. And now my heirs get it at whatever the cost basis is or whatever the price is on the day I die. So that's called step up in basis. All right? So that's what you want to do. You want to sell what you've got in your IRA, probably your best potential growth stock, move it to your non-qualified account, buy it back, and then hold it and pass it to your heirs with a step up in basis. That's how you beat the tax system. Okay? Now, then there is the question of I've got $40,000 worth of ordinary income that I'm taking in that I'm going to be taxed on. So how can I offset that? How can I beat them at the game? Well, I'm working. I do this. I earn money. I have thus then what is called a solo 401k. A solo 401k is sitting inside my limited liability corporation. I am the employer as the LLC of Carrie Grinkmeyer, the employee. The employee in my solo 401k is allowed to put aside $19,500 a year. Okay. Nita is also an employee, $19,500. We're almost there that we can contribute to the 401k the same amount that we're taking out of our qualified plans as required minimum distribution. So we're offsetting the income. Now, the other advantage of the solo 401k, remember, I have an employer. That is my LLC. My LLC is also able to contribute up to 25% of my annual income in contributions. So that brings it up so that Nita and I can, between employees and employer, we can put aside $56,000 apiece, or roughly $112,000. I don't know that we will get to that extent, but what I'm showing you is even though I'm going to have an ordinary income intake from my required minimum distribution, I can negate it or offset it by making a contribution to my solo 401k. Now, next year, will I have to take a required minimum distribution from my IRAs as well as my solo 401ks? Yes, I will. Okay? But I still have this ability to offset between Nita and I up to, what did I say it was, $112,000 a year. So I'm managing my taxes, and that's what I want you to think about. I want you to give you another motive to come to the realization that you need to find another job. You need to find another way to earn money in your retirement. And I just want to share with you that this is not my father's retirement. My father did not have the digitalization of his talents, his skills, his learned abilities. He couldn't do that. He didn't have the internet. He didn't have the capability of monetizing everything that he had learned in the preceding 60 years of his life. Okay? That's what I have done. I have basically monetized what I've learned, and I'm sharing it with you, and Google is paying me for sharing it with you. Okay? So that's all I'm doing. And the beauty of it is I love doing it. I really do. In addition to that, I'm creative. I like to make videos. I also like to write books. So my books are available on Amazon.com. So I collect royalties as well. So I just want to impress upon you. My father believed when he retired he was done. His life now consisted of playing golf and going fishing with his sons. Okay, that was it. That was it. He did not pursue any form of generating. He did not cash in on the first 65 years of his life. He just let it go. Well, I'm not going to do that. And I want to impress upon you that you don't have to do that. You have some talents, some skills, some abilities that you can share, that there are some 22-year-olds who would like to know what you know. Well, share it. I see people sitting in their garage teaching other people how to use tools, how to use electric tools. I watch, This Old House, and I'm marveled at how these old guys know how to use tools. Well, you know how to do that, or you know how to do something else. Monetize it. Monetize it. It's a wonderful word. Okay, that's how I'm managing my taxes. I hope this video gives you some insights into RMDs, required minimum distributions, and how you need to manage them. Okay, if you've earned some money and you've got a qualified account, you're going to have to take it out. If you don't, they'll penalize you. I think it's a 10% penalty if you don't take your RMD. So that's my insight on it. I hope that helps you. Do me a favor, subscribe to the channel, and then ring that bell. There's a little bell down there. That'll notify you every time I put out a new video. Right now, I'm putting out about a video a day because I want to get my inventory up so that I can answer a lot of your questions. Eventually, I'm going to pull it back to maybe 2 videos a week because I'll run out of things to share with you. Not really. All right. Talk to you later. I hope this is helpful. And again, ring the bell. Give me a thumbs up and give me some comments. I'm not getting many comments here. Over on my Best of Us Investors, I get a ton of comments, but nothing over here. All right, I'll talk to you again soon.